August 6th, a day of reckoning. The markets woke up shaky, haunted by whispers of an AI-driven economic slowdown. Then the opening bell rang, and all hell broke loose. The S&P 500 plummeted. By the closing bell, it had shed nearly 7% of its value. The tech-heavy NASDAQ fared even worse. It nosedived 9%, with giants like Apple and Microsoft shedding billions. This wasn't just a blip, it felt like the floor was giving way. Panic was palpable on the trading floors. The catalyst? A perfect storm of anxieties. Inflation was still high, casting a shadow over consumer spending. The Federal Reserve had been raising interest rates, making borrowing more expensive. And then, there was the elephant in the room. Artificial intelligence. For months, AI had been the darling of Wall Street, but the honeymoon phase was over. On August 6th, that fear found its outlet in a massive sell-off.
The tremors from Wall Street's earthquake were felt across the globe. The Nikkei 225 plunged 12%, its worst day since 1987. European markets followed, with the FTSE 100 and DAX shedding over 5%. The MSCI Emerging Markets Index tumbled nearly 8%. It was a global rout, fueled by fear and uncertainty. The speed and ferocity of the sell-off caught many off guard.
Then, almost as quickly as it began, the panic subsided. The very next day, August 7th, the market staged a remarkable rebound. The S&P 500 roared back to life, gaining back more than half of its losses from the previous day. The NASDAQ, too, recouped a significant portion of its decline. Across the globe, markets mirrored the recovery in the US. The Nikkei, after its terrifying plunge, bounced back by over 6%. It was as if someone had hit the reset button, leaving investors bewildered and slightly dazed. The term New Black Monday began circulating, a nod to the infamous 1987 crash, followed by a swift recovery. But unlike Black Monday, where the reasons for the crash remained murky, this time there was a growing consensus. The market had overreacted. The sell-off, many argued, had been driven by fear, not fundamentals.
Another factor driving the rapid recovery was the sheer amount of cash sitting on the sidelines. Estimates suggested that institutional investors, hedge funds, and wealthy individuals were holding trillions of dollars in liquid assets, waiting for the right moment to invest. The sharp drop in stock prices presented a tempting opportunity. For those with cash on hand, the sell-off was a fire sale, a chance to scoop up undervalued assets. This buy-the-dip mentality, fueled by the belief that the market had overreacted, provided a powerful upward pressure on prices. This abundance of liquidity, however, was a double-edged sword. If too much money chased too few opportunities, it could lead to inflated asset prices, setting the stage for future corrections.
Section 5. The AI effect more hype than habit? At the heart of the market's volatility lay a fundamental question. Was the world ready for the AI revolution?
While artificial intelligence held immense promise, its impact on the economy remained unclear. The initial euphoria, fueled by the promise of a productivity boom, had given way to a more sobering reality. Consumers, it turned out, were hesitant to embrace AI tools.
The adoption rates for AI-powered products and services were lagging behind expectations. The promised productivity gains, while evident in some sectors, were not materializing across the board.
This consumer resistance had a ripple effect on businesses. Companies that had invested heavily in AI, anticipating a surge in demand, were left with expensive infrastructure and underwhelming results. This disconnect between expectation and reality contributed to the market's unease.
Section 6. The Fear Index. A contrarian indicator? In the aftermath of August 6th, market watchers kept a close eye on the VIX, often referred to as the Fear Index. The VIX measures the market's expectation of future volatility, and it had spiked to levels not seen since the early days of the pandemic. A high VIX usually signals heightened fear and uncertainty. However, some analysts viewed the spike as a contrarian indicator. They argued that extreme fear often precedes a market bottom, as investors, driven by panic, sell their holdings at any price. This contrarian view suggested that the worst of the sell-off might be over. As fear subsided and investors regained their composure, the market could be poised for a rebound. However, others cautioned against reading too much into the VIX. the market remained volatile and further shocks could not be ruled out.
Section 7. Whispers of a bubble. Are we ignoring the signs? The rapid recovery in stock prices, while reassuring to some, raised a troubling question. Were we in the midst of a bubble? Asset bubbles occur when prices of assets like stocks, real estate, or cryptocurrencies become detached from their underlying value, driven by speculation and hype. Several factors pointed to a potential bubble. Interest rates, while rising, remained historically low, making it cheap to borrow money and invest in riskier assets. This abundance of liquidity, coupled with the fear of missing out, FOMO, among investors, fueled a relentless pursuit of returns. The rise of passive investing, where investors poured money into index funds that tracked the broader market, further amplified the bubble. The warning signs were there, but were we choosing to ignore them?
Section 8. The Fed's Dilemma. Walking a tightrope. The Federal Reserve, tasked with maintaining price stability and promoting full employment, found itself in a precarious position. The surge in inflation required a response, but raising interest rates too aggressively risked triggering a recession. The Fed had to walk a tightrope, carefully calibrating its monetary policy to tame inflation without choking off economic growth. The August 6th market sell-off added another layer of complexity to the Fed's decision-making. A sharp economic downturn could further erode consumer confidence and exacerbate market volatility. However, failing to address inflation could lead to a wage price spiral, where rising prices led to demands for higher wages, further fueling inflation. The markets, ever sensitive to the Fed's actions, watched nervously, trying to decipher the central bank's next move.
Section 9. The new normal volatility is here to stay. The events of August 6, 2024 served as a stark reminder that market volatility was the new normal. Gone were the days of steady, predictable returns. The confluence of factors, from geopolitical tensions to technological disruptions to the lingering effects of a global pandemic, had created an environment of heightened uncertainty. Investors had to adapt to this new reality. The buy and hold strategy, once a cornerstone of long-term investing, might no longer be sufficient. Investors needed to be more agile, more discerning, and more prepared for sudden shifts in market sentiment. This new era of volatility demanded a different approach to risk management. Diversification both across asset classes and geographies became even more critical.
Section 10. Lessons from History, a reminder from 1987. As the markets grappled with the aftermath of August 6th, it was worth revisiting the lessons of history, particularly the infamous Black Monday crash of 1987. On October 19th of that year, the Dow Jones Industrial Average plummeted over 22% in a single day, the largest one-day percentage drop in history. The 1987 crash, like the events of August 6, 2024, was triggered by a confluence of factors, including program trading, overvaluation, and a loss of investor confidence. Despite the severity of the crash, the markets recovered relatively quickly. The Federal Reserve, under the leadership of Alan Greenspan, acted swiftly, injecting liquidity into the financial system and reassuring investors. Within 2 years, the market had fully recovered. The lessons of 1987 were particularly relevant in the current environment. Section 11. The future is unwritten, navigating the unknown. As the dust settled on the August 6th sell-off, the future remained uncertain. The global economy was at a crossroads, grappling with multiple challenges, from inflation and rising interest rates to geopolitical tensions and the unpredictable trajectory of technological change. The stock market, a forward-looking mechanism, reflected this uncertainty. It was impossible to predict with certainty whether the August 6th sell-off was a blip on the radar or the beginning of a more prolonged downturn. In this environment of heightened uncertainty, investors needed to be prepared for anything. A diversified portfolio, a long-term perspective, and a healthy dose of skepticism were essential tools for navigating the unknown. The key to success lay not in predicting the future, but in preparing for it, in embracing uncertainty, and in maintaining a long-term perspective amidst the inevitable short-term noise.